Welcome to CoreLogic RP Data's update on housing market conditions from May 2016, brought to you by Smartline Personal Mortgage Advisors. At the start of this month, we've seen another cut to the cash rate, taking official interest rates down to a new historic low of 1.75%. With most of Australia's largest banks passing on the full rate cut, we're likely to see the standard typical variable mortgage rate for owner-occupiers slip to approximately 5.4%. The latest cut to mortgage rates has been more than enough to reverse the rate lift seen in late 2015 when APRA implemented rules on higher capital requirements on residential mortgages. Australia hasn't seen mortgage rates this low since July of 1968. Whether lower mortgage rates will stimulate the housing market enough to see a rebound in the rate of capital gains is yet to be seen. However, with lending criteria having tightened through 2015 and lenders even more vigilant around housing market risk, we aren't likely to see a substantial rebound in the rate of capital growth, which has broadly been trending lower since mid-last year. Despite the moderating trend in the rate of home value growth, capital city dwelling values were up 1.7% over the month of April. That's a sharp rise from the negative results recorded over the final quarter of 2015 and the relatively soft conditions seen over the first quarter of this year. The latest monthly data takes capital city dwelling values 3.3% higher over the first 4 months of the year so far. Growth in dwelling values over the first 4 months of 2016 has been broad-based, with Perth the only city where home values haven't recorded a rise. Values are down 0.5% in Perth so far this year, while the highest growth rates have been in Sydney and Adelaide, both up 4.5%, and Hobart values are 4.4% higher. The longer-term trend still shows Perth and Darwin to be the only capital cities where values are lower over the past 12 months. Darwin dwelling values peaked in May of 2014 and have since fallen by a total of 6.2%. Perth's been more resilient to a correction, with dwelling values falling 4.2% since peaking in December 2014. Melbourne's showing the highest annual growth rate at 10.1%, and it's the only capital city to record annual growth in the double digits. The growth over the past 4 months has also been confirmed with clearance rates that have been consistently in the high 60% to mid 70% range across Sydney and Melbourne during April. Compared with December last year, when clearance rates were recorded as low as 52% in Sydney and 63% in Melbourne, the current clearance rates have bounced and held higher. Transaction volumes are painting a softer picture of housing market conditions, with the number of home sales drifting lower in most capital cities. Year-on-year sale numbers are down nearly 16% across the combined capital cities, with the largest falls being recorded in Darwin, where annual home sales were down 25% compared with a year ago. Sydney transaction numbers were down 15%, Melbourne by 14%, and Perth sales are 14% lower than a year ago. While values continue to broadly rise, rents aren't doing much at all. Weekly rents were virtually flat over the first 4 months of the year, and they're down by 0.2% over the past 12 months. The fact that rents are being substantially outperformed by values has continued to push rental yields lower. In fact, both Melbourne and Sydney are once again seeing gross rental yields at record lows. Hobart's now the highest yielding capital city after Darwin slipped down from the #1 position due to large falls in weekly rents over the past year. As always, the differences between the housing markets and product types are significant from region to region. Sydney home values are up 4.5% over the first 4 months of the year, with a relatively similar performance between houses and units. In fact, Sydney's unit market is now seeing a stronger annual rate of growth compared with houses. Unit values are up by 11.5% over the past 12 months, compared with an 8.4% rise in house values. The trend rate of growth showed a slight improvement over the month. However, compared with May last year, when Sydney dwelling values were rising at 18.4% per annum, the market's clearly slowed. With transactions now trending lower, we're also seeing listing numbers rising across the Sydney market to be 22% higher than a year ago. While the rise in stock levels compared with a year ago is substantial, listing numbers in Sydney are moving off a very low base and remain almost 35% lower than the peaks last seen in 2012. Nonetheless, higher stock levels means good news for buyers, with more choice and more ability to negotiate. Melbourne's housing markets continue to show a large difference between the rates of capital gain for houses compared with units. Over the first 4 months of the year, Melbourne house values have increased by 3.7%, compared with a 0.4% fall in unit values. The trend is more substantial over the past 12 months, with house values up by 10.8% compared with a 4.7% rise in unit values. High supply levels are likely to weigh down the rate of capital gains for inner Melbourne units for at least the next 2 years, with CoreLogic's settlement risk report showing 31,000 units are due to settle across the inner Melbourne market over the next 24 months. Another weak point in the Melbourne housing market is the low yield profile. Gross yield slipped to a new record low in Melbourne, with a typical Melbourne house now showing a gross yield profile of just 2.9%, while the average gross yield on a unit is 4%. Brisbane dwelling values recorded a further 2.2% rise in dwelling values in April, taking the annual growth rate to 6.2%. That's the highest annual growth rate in Brisbane since September 2014. Similar to Melbourne, most of the growth in Brisbane's housing market is coming from the detached sector, where values are 6.7% higher over the year, compared with a 1.2% rise in unit values. Housing demand in Brisbane is holding reasonably firm compared with the larger capital cities. However, rents are weakening across the city, with weekly house rents down 0.5% over the past year and 1.3% lower for units. The soft rental conditions, coupled with stronger capital gains, is pushing Brisbane's rental yields lower. However, yields in Brisbane remain higher than most of the other capitals. Adelaide's housing markets posted a strong performance so far this year, with dwelling values rising by 4.5% over the first 4 months of the year. The annual growth rate in Adelaide is now 3.6%, highlighting that the recent growth conditions have been substantially stronger than the annual trend. The strong growth conditions are surprising given the economic uncertainty across South Australia. However, transaction numbers have also been trending higher over the past year, suggesting that market demand remains reasonably healthy. The trend rate of capital gains across Perth's housing market has recently started to improve after dwelling values have been declining for more than 12 months now. The annual rate of decline found a recent trough in January this year, when values were falling at the annual rate of 4.1%. Since that time, the annual rate of decline has lifted to negative 2.1%, and transaction numbers appear to be levelling out after starting a downward slide in late 2013. This is very much a buyer's market, with listing numbers higher than a year ago across Perth, which has pushed the average selling time out to just over 2 months. Weekly rents have shown a substantial fall over the past year, down almost 9% over the past 12 months. Hobart home values are gradually trending higher, with a 1.1% rise over the past 12 months. However, the market reading has been volatile. The sheer affordability of the Hobart marketplace is likely to be one of the most attractive elements of this market, with a median house price of just $350,000. Rents are rising at a slightly faster pace than dwelling values, which has pushed the yield profile slightly higher. In fact, Hobart yields are now the highest of any capital city, which is likely to be an incentive for investors. The number of homes for sale is reducing rapidly across Hobart, with 27% fewer homes available for sale now compared with a year ago. Darwin dwelling values were down in April. However, thanks to some subtle appreciation in the earlier months of the year, Darwin dwelling values have moved 0.6% higher over the first 4 months of the year, which may signal some improvement in the weak trend that's been evident in Darwin since May 2014. While dwelling values have reduced by 3.7% over the past 12 months, the real weakness seems to be in the rental market, where weekly rents have fallen by 12.6% over the same period. The fall in rents has toppled Darwin from the #1 yield position it's held for so long. Despite yields moving lower, at 5.3% gross for houses and 5.1% for units, Darwin still ranks amongst the highest yielding capital cities, together with Hobart and Brisbane. Canberra home values rose by 1.2% in April to take values 3% higher over the year to date and 4.5% higher over the past 12 months. Most of the capital gains in Canberra can be attributed to appreciation in house values rather than unit values. House values are 4.8% higher over the past year, while unit values have edged 1.2% higher. The number of homes on the market has also reduced substantially over the past year, down by 17.3% compared to the same time a year ago. That provides less choice for buyers, which is likely to provide some further upwards pressure on prices. Overall, we're looking at housing market conditions that are still broadly rising, but not at the same pace as they were 6 months ago. There is some risk that lower mortgage rates could stoke housing demand higher. However, my guess is that lower interest rates will continue to provide a floor under housing demand and help to retain buyer confidence without reigniting the boom in home values that was very much evident up to the first half of last year. Affordability constraints and low rental yields are two factors that will help to keep a lid on the pace of capital gains, but also stricter lending conditions and higher housing supply are likely to play a role as well. Investors are still facing a 30 basis point premium on their mortgages, and lenders are still generally insisting on deposits of at least 20% for the majority of their new loans. The result is a slowdown in investment activity in the market after this segment peaked in May last year at 55% of all new mortgage commitments. There's also some growing risk around supply coming into the apartment markets of inner Melbourne and inner Brisbane. CoreLogic's settlement risk report identifies approximately 31,000 new apartments that will settle across inner Melbourne over the next 2 years and about 17,500 units across inner Brisbane. With the rate of capital gain weak across both the Melbourne and Brisbane unit markets, there is some risk that off-the-plan purchases could show a settlement valuation that is lower than the contract price. If this does turn out to be the case, some buyers may face higher than expected financial costs to maintain their loan-to-valuation ratio requirements. As we approach the federal election, which is likely to be held on July 2nd, housing will continue to be a key topic of debate. The latest federal government budget announcement had no changes to negative gearing or taxation policy related to housing, which is in direct contrast to the Labor policy, which is to allow negative gearing on newly built properties only, as well as halving the capital gains tax concession from 50% to 25%. As always, CoreLogic will be providing the market with insights and analysis based on statistical evidence and facts, which will hopefully help to guide the housing debate in a positive direction. Thanks for tuning into our monthly housing market update. Remember, you can find more detailed analysis and commentary at our website at www.corelogic.com.au.